Daily Pulse. Today's market action reflects the sharpening divide between narrative and fundamentals. In Forex, the dollar continues to move less on economic data and more on positioning. As capital looks for safety, even marginal political shifts are triggering outsized currency reactions. Watch for continued pressure on the euro and yen, especially as energy security becomes a renewed concern in Europe and inflation data underwhelms in Japan. In emerging markets, currency weakness is accelerating as central banks run out of room to defend their positions. Expect to see more aggressive rate moves or capital restrictions in fragile economies. This creates secondary opportunities for tactical forex trades, but the window is narrow and heavily sentiment-driven. Crypto markets remain tightly linked to regulatory pressure and macro liquidity. Bitcoin is holding key levels, but movement is cautious. Institutions remain hesitant, but retail flows are picking up slightly. The market is waiting on a broader risk signal. Until then, we remain in a slow grind with flash bursts of volatility. Gold continues to outperform expectations. It is not reacting solely to inflation, it is reacting to mistrust. Central bank demand remains strong, and ETFs are beginning to see inflows again. The metal is reclaiming its role as the signal of global uncertainty. The more headlines about debt ceilings, trade disputes, and digital currencies, the stronger gold's positioning will be. This isn't a market about optimism or recovery. It's a market about reaction and positioning. The story continues to be one where money flows to uncertainty and prepares for what comes next. The world economy is changing faster than most realize. In this video, we break down the 7 key global trends that are reshaping how capital flows, how currencies behave, and how trust is formed in a divided financial system. These aren't just temporary headwinds. They're the foundation of a new global order. From supply chain realignments to sovereign debt instability, from the rise of AI-driven nationalism to the clash between digital repression and freedom, each trend reshapes how capital behaves. Markets now respond to narrative as much as they do to numbers. In this new era, strategy requires more than charts or forecasts. It demands the ability to read how systems bend, break, and transform under pressure.
The global economy is entering a new phase, marked not just by competition for growth, but by strategic positioning in a world that feels increasingly uncertain. In this climate, money doesn't simply follow fundamentals, it follows risk, narrative, and power. In the forex markets, the US dollar is likely to maintain its dominant position, not solely because of domestic strength, but because of its continued role as a global anchor during instability. However, its dominance will face more frequent challenges, particularly from regions seeking greater monetary autonomy. The euro and yen remain vulnerable to sluggish growth and internal divisions. Emerging market currencies face rising debt service costs and political unpredictability. Interventionist tactics, such as rate manipulation or capital controls, are expected to become more frequent as nations attempt to manage growing volatility. Crypto assets are entering a critical junction. Bitcoin, in particular, is increasingly viewed not just as a speculative asset, but as a geopolitical and technological hedge. As centralized systems grow more controlling, through policy, surveillance, or digital fiat systems, there will likely be renewed attention to decentralized networks. Altcoins will fragment, with many losing relevance unless tied to real-world use cases or privacy infrastructure. Meanwhile, CBDCs may accelerate globally, promising efficiency but often introducing new constraints. Gold remains a historical constant during uncertainty. Its appeal continues to rise, not just from investors, but from states accumulating reserves in anticipation of future financial realignments. Central banks across multiple regions have been steadily increasing gold holdings as a way to diversify away from fiat dependency. Supply constraints and increasing sovereign demand will likely drive long-term pricing pressure. Across all 3 asset classes, forex, crypto, and gold, there is a shared theme. Markets are adjusting to a world where conflict, fragmentation, and rapid policy shifts are part of the new normal. Traditional investment strategies based on stability and long-term projections are giving way to more fluid, reactive approaches. Those who can track sentiment, power dynamics, and capital flow constraints will navigate this transition more effectively. This is not the end of markets. It is the beginning of a different logic governing them.
Sources/reasoning. USD dominance during global volatility. Historical flight to dollar in crises. Structural pressures on euro and yen from energy, demographics, and stagnation. Emerging markets impacted by global rate cycles and commodity-linked unrest. Bitcoin's increasing relevance during sanctions, capital restrictions, e.g. Russia, Argentina. Growing CBDC rollout and surveillance concerns. China, Nigeria pilot programs globally. Central bank gold accumulation trends. WGC data. 2022 to 2024. Shift to narrative-driven market behavior in the social media and AI trading era.
Title: Predictive Economic Outlook Amid Strategic Geopolitical Rebalancing. Executive Summary. This document offers a projection of macroeconomic trends shaped by emerging patterns in global development and regionally concentrated tensions. While top-level indicators present a veneer of continuity, undercurrents in institutional behavior, capital flow redirection, and resource-linked policy suggest a divergence from conventional forecasting frameworks. Regional sensitivities and sector-specific capital dynamics developments in zones of heightened strategic interest have been accompanied by noteworthy movement in capital toward advanced manufacturing and logistics. Forward-looking contract expansion is observed. Energy distribution and raw input management. Anticipatory volatility continues to present a range of strategic entry points. Large-scale development funds, infrastructure adaptation, and regionally adaptive planning appear to be gaining renewed traction. These trends reflect an economic pattern where security-adjacent and post-disruption sectors receive escalated capital attention in moments of multi-vector uncertainty. 2. Recalibrated risk modeling and value capture responses from market entities show a shift toward recalibrated assessments. Institutional tolerance for extended debt exposure persists. Increasing divergence between collective cost-bearing and concentrated benefit collection. Certain sectors display inverse correlations with volatility, reinforcing their attraction during strategic events. 3. Evolving institutional interfaces. Confidence structures are subtly adjusting. Monetary policy implementation has transitioned towards systemic liquidity assurances. Regulatory oversight often trails cross-sector innovation, providing temporal asymmetries. Localized economic coordination exhibits signs of modest expansion in response to central lag. 4. Behaviorally conditioned capital migration. Consumer and investor behavior continues to reflect momentum detached from surface-level risk discourse. Instead, capital is trending toward platform-integrated security operations, latent infrastructural control layers, distributed food system nodes. This suggests emerging value paradigms shaped by preemptive necessity rather than reactive ideology. Forward-looking market positioning. If fragmentation and environmental constraints persist, the landscape may continue toward widening divergence between stated policy objectives and actual capital alignment. Valuation elevation for functionally resilient investments. Strategic dual positioning, wherein both volatility-tolerant and fundamental stability assets coexist within institutional portfolios. Conclusion. This outline avoids prescriptive moral analysis, focusing instead on observable reallocations and anticipatory strategy in the